Well, the last couple of days have been really tough for the markets, but I think this credit shock that's reverberating from the Silicon Valley Bank failure is the first signs that the Fed's monetary policy is finally biting. I mean, and I think, one of the takeaways we have when we look at what Fed fund futures have done, which is now priced in cuts by year end, and the drop in yields, is that there are some deflationary forces being unleashed because of both the shock to the startup community and the regional banks having some tightening of lending standards that's surely to follow. And I think it does mean disinflation maybe finally have happened. We may have sort of broken the back of inflation.
All right, we have some breaking news right now from the Fed. Steve Leisman has the details. Steve.
Thank you very much, Morgan. The Federal Reserve at this hour is announcing a review of Silicon Valley Bank and its supervision of Silicon Valley Bank in light of its failure. We have a quote here from, excuse me one second. We have a quote here from Michael Barr, the Vice Chair of Supervision, who will lead this. He says we need to have humility and conduct a careful, thorough review. Fed Chair Powell saying the events surrounding Silicon Valley Bank demand a thorough, transparent, and swift review by the Federal Reserve. They are promising to make that review public as of May 1st. So fairly quick timeline for the Federal Reserve. Morgan?
Steve Leisman, thank you. Tom, I want to get your reaction to that because you just mentioned the Fed funds futures market and just the dramatic repricing we've seen there in the last couple of days. Scott, at the end of the 3 o'clock hour, noted that the 2-year Treasury note has slipped below 4%. We've seen the de-inversion pretty dramatically. It's still inverted, but not nearly as much of the 2 to 10-year spread as well. What is the bond market signaling here, and what does it tell us about the Fed next week and that weighing by Federal Reserve officials of inflation that's still high versus now the possibility of risk and something potentially being broken within the banking industry?
Yeah, I mean, there's a couple of reasons that yield curve is de-inverting because, the curve that people are referring to is the 10-year versus the 2-year. It could be de-inverting because financial conditions in terms of Fed policy is starting to ease, and that's why the 2-year is dropping. The 10-year never really responded. It could also be de-inverting because you're breaking inflation. If inflation is no longer going to be running at 5% the next 2 years, and the 10-year was always forecasting roughly 2, you're going to de-invert as inflation's breaking. So I think it means something definitely broke. I don't know if it's the economy or if it's inflation.